Welcome to another episode of What's on Your Mind, a show hosted by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets over the last week. I'm Chris Quill, and today I'm joined by Jason McDonald and Chris Cathey, who together actually represent the UK contingent of Institute senior trading mentors, so it'll be great to catch up with them. But just before we jump into the show, I want to point out to you guys watching and listening that if you want to learn more about the sort of material that we cover in these episodes, or more about trading and investing in general, then be sure to check out our website, itpm.com, and from there you can see a lot of different links and resources to educate you further. So things like our live upcoming seminars, our online courses, bite-sized videos, and mentoring programs that we do around the world. So with that being said, let's jump straight back into the show. And Jason, I think we'll start with you this week. What's been on your mind?
Yeah, hi to the two Chris's.
Hi, Jason.
Yeah, I mean, it's really kind of a continuation of some of the things that have been raised in previous episodes. So firstly, I probably want to point out from the beginning that as we all know, we've had some good success in some of our emerging market trades. And we've actually been, as both the company and some of the individuals that have had these trades on as well, have actually been closing some of those emerging market shorts in both equities and things like the Turkish lira and the South African rand. And sort of following on from that, China is a place that never is really far from our minds because of clearly the significance and importance that economy has and will increasingly have with respect to the global growth situation. So one thing that really did catch my attention was that the latest Caixin China manufacturing PMI, which continues to bump along just above the 50, which, as you know, is anything 50 and above is expansionary, but we're talking about some fairly anemic numbers here coming out of China now. That's down again in August from the previous month. It's only at 50.6, which is just above 50. That's also a 14-month low. One of the worst aspects of that latest report as well was new orders growing the least since May 2017. As some of you are probably aware as well, a lot of this is related to the trade stuff that's been, the trade dispute that's been taking place between America and China. That's actually had a knock-on effect, not just to the economy, but as you would expect, that's also led to the Shanghai and Hang Seng markets being particularly weak since January, both of them down 20% and 20% plus since that time. Now, interestingly for me, one of the areas that I concentrated on when I was on some of the prop desks that I worked on was Australia. And Australia is a country that's very much affected by what happens with China. The obvious link being that the Aussie economy is obviously very much driven by what happens in the commodities world. So to do with natural resources, where does a lot of the demand come from for the core natural resources? It's obviously China as well as India. So when the Chinese economy is looking weaker, that's definitely going to have implications for Australia. So that's one of the things that I've been thinking about. In relation to Australia itself, we've seen the latest NAB Business Sentiment survey has dropped to a 2-year low in August. That's actually fallen from a reading of 12 in January to a reading of 4 last month. If we start to look at things like the Aussie dollar, which I'd advise people to look at possibly the correlation between the Aussie dollar and things like that business sentiment survey. And I think that we can see that there are definitely some signs of weakness there overall in the Australian economic situation. But drilling down further, so one of the things that I've noticed as well is that broad money supply in Australia since Q1 has also decelerated sharply. This clearly has effects with respect to the big 4 Aussie banks. So I will make I'll say up front, I'm talking my own book here. I've been short, not for very long actually. These are relatively recent shorts that I've got on in terms of I've got a basket of short positions in Aussie banking equities. I'll also say at this stage that this trade is also known as the Widowmaker because it's not a new trade, it's not a new idea. Like the best ones, it's not really the thinking behind it. It's often the timing. So it's been called a Widowmaker because, a bit like calling the top of the market towards the end of an aging bull, a lot of people have been looking at the Aussie property market and thinking that's in a very toppy situation. I think the difference this time round is that we've actually seen some broad indicators falling that I've mentioned. We're also looking at situation where, in terms of affordability, the income, so house prices to income ratios are actually now at levels that would double the kind of peak ratio levels for the USA in 2006, 2007. I think we know what happened then. So I think you've got a few things that are kind of all, sort of coalescing together at the moment. You've actually seen some house price and property price falls for the first time in 6 years in Melbourne and Sydney. Those are the two biggest markets by value. I think they account for about 2/3 of the Aussie property market. So you've also got, as is well documented, we've got quite large absolute amounts of debt there. I think it's $1.8 trillion of mortgage debt. This is for a population of 25 million people. So when these numbers are not new, but I think that given some of the things that are happening around the world, it might be the time for for that trade to be a good trade. I can give you lots of statistics. So sorry, Chris.
No, I was just going to say you're probably going to expand on that a little bit more. But I was going to say, are there kind of almost derivative ideas that come from the housing potential crisis? So not just banks. Do you think that could be more systemic and cause other issues, or is that not really the trade to look at the moment?
I'm looking at a more Australian specific trade. But the starting point of the discussion was some of the things that we're seeing coming out of China. I don't think you can look at Australia without looking at China. And also, it's not just the natural resources angle, it's also the fact that a lot of the buying in Aussie property in recent years has been investor led, and a lot of those investors have been from China. So you've got a kind of secondary feedback there as well, not just in terms of the domestic situation with respect to affordability, but also to do with, well, where are the marginal buyers of apartments and properties coming from in Melbourne and Sydney? Well, a lot of them were coming out of China. Maybe that's not going to be the case going forward.
Hey, Jason, that sounds very dangerous.
Yeah, I think it is. I think that you've got I think UBS came out with a report saying that in the next 2 years you could see mortgage financing dropping by something like 30 to 40%, which is obviously massive.
That's huge. That's absolutely huge.
And the other aspect is that you're not really backed up on a valuation perspective with Aussie banks. So that's the issue. People go for them because they've got decent dividend yields, but of course, as you and I both know,
absolutely,
those dividends can come under threat. And then when that support is removed, we know what happens.
Absolutely.
And when we're talking about Aussie banks, some of them at 2.5 times book value is what they're trading at.
Jesus.
Those were the type of 2.5, 3 times book value is what we saw in 07, 08 before what.
Exactly. I think you touched on it there, given the fact that the affordability is twice what it was in the US compared to 06 and 07, and at 2.5 times book value, that's comparable to, like you said before, the financial crisis. This could get very ugly very early.
Yeah, and at the very least, you've got to ask yourself the question: what is my downside from being short of these things?
Exactly.
Words, what's my upside? Why would I buy them in the first place? And what's my downside from being short of them?
Doesn't look as though China's going to turn around anytime soon, does it?
Exactly. Yeah. And the other thing that you're seeing as well is there's been a bit of, as you've seen in a lot of Western economies, there's been a bit of social unrest and discontent about the fact that the locals are finding it obviously virtually impossible to buy property. And so the Aussies, as we know, their politicians are quite trigger happy when it comes to imposing new regulations and stuff. They've actually already started to impose restrictions on 100% interest-only mortgages, foreign buyers. So,
Right.
the thing is that can obviously lead to a kind of, it goes from a virtuous circle to a vicious circle where you remove that demand, which means that people who were highly levered and basically not reliant upon yield, but reliant upon property prices increasing, those prices stop going up. They've actually started to come down, not massively, but the fact that they're coming down is a worry. You then get the negative feedback loop.
Absolutely, very quickly.
Prices and over leveraged, etc., etc. So I think it's a relatively low risk trade, and I think that the timing could be coming into play now. So
which of the 4 banks would you go for?
Well, I'm actually short of Westpac, Commonwealth, and NAB. I think you've got to do the 2 of those in particular. I'm very keen on being short of. I won't say which 2. I think people need to do their own homework. But those are the 3 I'm short of. That only leaves ANZ out of the 4.
Right.
So,
okay. Cool.
We'll see where that goes. At the moment, it's I'm small up on that trade. I timed my entries fairly well. The other thing, of course, which I forgot to mention, is the Royal Commission, which is an investigation that is going on into the potential. Well, it's not potential. It's pretty much obvious that Aussie banks have been involved in fairly lax lending standards. Things like liar loans are coming up. Basically mispractice. I mean, CBA, the Commonwealth Bank was fined $700 million last year for essentially facilitating money laundering. We've got a Royal Banking Commission investigation going on that started in December of last year. It's due to report by February of next year. They are going to need to address a lot of these issues that have arisen as a part of that investigation. I think you're going to see tighter lending standards at the very least. You could see more fines. So all in all, you put all that stuff together, I think you've got a few catalysts, and I just don't think that it's going to be. I don't think that's I think that's a low risk trade for me to do.
Sounds like there's a very limited upside anyway.
Yeah, limited upside to being long for sure.
And it sounds as though the Australians haven't learned anything from the financial crisis, because it sounds very similar to the backdrop to sort of 05, 06, 07 in the US. Yeah,
and I think there's probably there's a bit of complacency there, because one of the oft repeated things about Australia is that they never went into a recession when the rest of the world obviously got hit by the GFC. That's correct. But this is a housing market that's been, it's been in a bull market almost as long as US Treasuries were in a bull market. So maybe that's slightly exaggerated, but you get the drift.
Yeah, absolutely.
So Chris, is there anything that you've been looking at that's, aside from, say, paying some attention to Australia and banks and things, what about closer to home in Europe or Britain?
Well, Jason sounds very much on top of the Australian situation. It sounds like a very compelling idea to pick your shorts and just sit tight, because, like you said, the Widowmaker means that you're going to get some squeezes along the way. But if you trade it accordingly and position size accordingly and give yourself some flexibility to trade, I think it sounds like a winner between now and the year end. It seems to me that, like Jason said, it's a very low risk trade to be short a few names in Australia. Actually, just as he touched on, I'm looking more into the US and European markets, and as Jason, just a little read across from what Jason was talking about, sort of China, given the fact that Hang Seng is already in a bear market, down more than 20% from its highs, it might be worthwhile flagging some of the mining stocks in the UK. My old favourite is BHP Billiton. I mean, it has been hit hard, very, very hard over the last few weeks. But I think it seems to be very limited upside from the information coming out of China. So maybe looking for some short UK mining stocks would be something to look at. But just moving into sort of a slightly different part of the world. So let's look into Brexit. Obviously, Jason and you, Chris, are all living in the UK, so we're bombarded with daily headlines about how good or how bad the negotiations are going on. But I think before we talk about the politics of the situation, I think let's just have a look at the backdrop to where we are in Europe and the UK. We've still got negative rates in the Eurozone, and the recent ESI and especially IFO in Germany suggest that the rate of growth in Europe is slowing quite dramatically over the last few months. We're clearly not anywhere near recession territory or anything like that, but it does seem as though both business and consumer sentiment is stalling and starting to slow. Coupled with the fact that, like I said, the ECB's got negative interest rates, we've also surprisingly got a pickup in inflation in Europe. Headline rates are now running north of 2%, which is above the ECB's mandate, their targeted rate, pretty much due to the oil price on a year-on-year comparison, and also clearly the euro weakness is stimulating some inflation in Europe. Puts the ECB in a rather tricky position because clearly growth stalling, inflation picking up, ECB's got their sort of hands tied a little bit. Can they raise rates? Clearly not, because growth expectations, and what can the ECB do to try and stimulate European growth? Now, just to sort of move into Brexit, just again to look at the backdrop to the European governments. We've seen a few, I say, sizable political shifts in Europe over the last 12 months. We've already got a populist government in Italy. We've had the Swedish elections recently. The Social Democrats still won the election with a massively reduced majority, and clearly far-right support is gathering some speed, gathering some momentum in Sweden. And we've got in Germany, we've got recent situations in Chemnitz, and also we've got the upcoming elections in the local elections in October. So we've got social unrest in Italy, we've got social unrest in Sweden, we've got social unrest in Germany. It doesn't particularly give the European government a very strong hand when it comes to negotiating the Brexit, which, as you all know, just remind you, runs out. Article 50 is May the 31st, 2019. So we've got 6-7 months left before the UK leaves
Sorry,
Europe.
Chris, is it not March?
March, sorry. Did I say May? Yeah, sorry, March 31st, 2019. My mistake. So it seems to me that
they'll probably extend it.
yeah. So I think we'll all be dead before Brexit's finished.
Yeah.
It does seem to me that the European governments, the Euro governments, are in a particularly tough spot here. Do they go for a hard Brexit, hit the UK hard for leaving Europe, put tariffs on any exports and any imports between UK and Europe? Is that realistic given the size of the UK market for especially the German car manufacturers, French manufacturers? Very, very dangerous to put tariffs on, potentially given the fact that business and consumer confidence is already stalling, could already tip Europe into recession. Or does it go for a soft Brexit, allow the UK to maintain trade links, etc., etc.? Probably not, because then clearly membership of the European Union means nothing. It potentially fatally damages the credibility of the whole project if the UK can leave without any consequences. So it does seem as though they've got a prisoner's dilemma right here, right now.
That's exactly what I was going to say, Chris. Yeah, it's the classic prisoner's dilemma, isn't it?
Yeah, they are damned if they do and damned if they don't.
Yeah.
And I think we all see it from a UK perspective, but I think we have to look at it from a European perspective. It's potentially far more serious. So again, coming back to, looking at the euro against the dollar, does seem to me as though, yeah, it's been hit hard, but it does seem to me that the upside seems very limited, and any rallies in the euro should probably be sold. And I don't think it's unrealistic to expect by year end that the euro is somewhere around about parity against the US dollar. That would be my sort of medium term target of the euro.
And Chris, would you short the euro against the pound as well?
I think yes, probably, yeah. I think there's always a risk that it's potentially more worse. Well, I think it's more worse for Europe than it is for the UK. And I would expect that would mean that the pound against the euro was probably a relatively good trade, yes. Long the pound, short the euro.
But your preference is euro dollar?
Euro. Absolutely, short euro dollar, because I think that's where you can get the biggest bang for your buck.
Yeah, okay.
And given, just to jump in, Chris, given the fact that you're looking at the sort of Brexit situation and what's happening in Europe where they're stuck with interest rates low and they can't really do much about it, what sort of sectors or other trades would you be looking at? Is it sort of exporters to Britain, or is it banks given those low rates?
Well, I think the obvious one is anything who has exports to the UK. So German car manufacturers, my old favourite's BMW. Look at the French car manufacturers, exactly the same situation. And actually, just focus on Germany for a second. I mean, Deutsche Bank, the problems persist. If anything's getting worse, I think Deutsche Bank could be a really interesting position. It has, again, been hit hard, but it seems to me that the upside's very, very limited in Deutsche Bank right here, right now. Given the fact that the Ep5 suggests that the German economy is starting to stall, I think they tried
sorry to interrupt you, because I think they trotted out the old rumor, which we've heard so many times in our career, about Commerzbank, Deutsche Bank.
Ah, yeah, that'll just it.
Yeah, but that just shows you how weak the situation is, doesn't it? That's getting trotted out again.
I would take that means that internally there are real issues in the German banks.
Yeah, totally agree.
I think that's the way I would read that. And it seems to me, I mean, like you said, it gets trotted out every few years. When you get close to a position of crisis, and usually means that something's going to get very, very bad very, very quickly.
Completely agree with that. Yeah.
Talking about banks, I think maybe also look at the Italian banks. It's maybe worthwhile headlining that the spread of the Italian bond against the Italian government bond against the German bond is around about 3%, which is kind of mid-range of where it has been since the financial crisis. About 18 months ago, it was about 1%. The height of the Greek crisis was about 5%. And given the populist government in Italy, and again, the recent numbers I think came out yesterday in Italy, where manufacturing growth is slowing very hard in Italy.
Yeah, that was a disappointing number. Yeah,
a huge disappointing number in Italy, and I think that, if anything, I would say that spread is going to widen against the bund rather than tighten. Yeah. So reading across from there, look at the major Italian banks: Unicredit, Banca Intesa San Paolo, potential shorts, potential longs against it. Well, I think the UK banks are relatively safe compared to the European banks right here and now. Again, it goes back to the pound against the euro, but I think maybe Deutsche Bank short, the Italian bank short, are potential positions that I'll be looking at. Just to sort of read into this negative situation, recent UK numbers do suggest that, okay, construction maybe seems to stabilise, but it seems to me it's a bit of a dead cat bounce before it starts to resume its downward trend. So maybe look at some of the UK construction names: Balfour Beatty, Taylor's, Barratt Developments. And I think looking at the price action in some of the US sectors right here and now, I have noticed that value players, defensive names in the US seem to be getting some kind of stability and sort of starting to try and trade to the upside. So names I'm looking at the US against some of these potential European shorts would be names like Kraft, Procter & Gamble, Johnson & Johnson, and United Rentals are names that sort of I'll be looking at. And my old favourite, I like the tobacco stocks, like Philip Morris in the US. It has been hit again, but I think it may be starting to sort of look attractive. The old bellwether for the US would be General Electric, another name to potentially long against some European shorts. And if you're looking for a more balanced portfolio in the UK or Europe, I think potential longs in the UK are three favourites of mine: British American Tobacco, Unilever, and Reckitt Benckiser.
Can I actually ask you about that Unilever situation?
Yep.
Yeah. What? So I mean, I've not followed it closely, but I've obviously seen some of the stuff with respect to the domiciling, moving the head office over to Holland, etc. Is that anything that we can take advantage of? Is there a trade there at all?
There may be an arbitrage because they have dual listings, UK and in the Netherlands. Ultimately, I think maybe the safer way to trade it would be to buy the Dutch stock, Dutch listing of Unilever. Because it is a very, very defensive name. It potentially, I think if it delists from the UK, the biggest impact would probably be UK tracking funds. So there would be probably some supply. So it maybe not the time to have a full position in Unilever, but it definitely be something I'd be looking to get long.
But as you say, if you're going to go for one, probably go for the Dutch one, I guess.
Go for the Dutch one. UK, keep the exposure by, I'll say, Reckitt Benckiser. That's it's about as safe as it gets in the UK against maybe some of the mining shorts and maybe some of the European financials.
Yeah. Okay.
So are those stocks that you just named, Chris? Is the sort of macro idea behind those basically that they're defensives? Defensives
and value. Yeah.
Right.
Which it's again, I think this is probably the classic end of a bull market. Maybe it's a bit too early, but you tend to find with these sort of names that once they get a trend, the trend can ride for quite a few months.
Mm. Yeah, there definitely appears to be a bit of a rotation taking place over the other side of the Atlantic.
Yes, I think the sort of, if you look at on the US, the headline numbers everything looks rosy. S&P's close to all-time high, but I think there's a lot more going on within the market. And I think potentially long defensives, short growth, short cyclicals, maybe something that some people want to maybe have a look at. And I've got to start to put a few positions on. I'll be looking to expand them over the next month or so because I think we're going to have some opportunities to do now in the year end.
Yeah, so basically build into them.
Exactly.
Yeah.
All right, so I think that's all we have time for on this week's episode of What's on Your Mind. Thank you, Jason and Chris, for joining me on the show today and sharing your thoughts with us. Now, just before I close the show, I want to point out to you guys watching and listening that if you want to learn more about the sort of content that we deliver in these episodes and learn more about trading and investing in general, then head over to our website itpm.com, where you'll find a bunch of different links and resources to further your education. So things like our live upcoming seminars, our online education programs, our bite-sized videos, and mentoring programs that we do around the world as well, which are with guys just like Jason and Chris, who can really take your trading to the next level. So that's all from us. Thank you guys very much for watching, and I hope you join us next time for another episode of What's on Your Mind.